Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now in this video I'm going to explain you the important concept, that is consumer surplus. So I'm going to cover up the meaning of the term consumer surplus, its definition, and then what are the assumptions and importance of consumer surplus, then how to measure the consumer surplus, and lastly what are the criticism against the concept of consumer surplus. Already in this unit number 3, supply analysis, I have given 2 videos and this is the 3rd video. In the first video I have explained you the meaning of the term supply, law of supply, determinants of law of supply, and supply schedule, supply curve, and assumptions of law of supply, exceptions to the law of supply. All these things I have explained in the first video. The second video on supply, I have explained about the elasticity of supply, types of elasticity of supply, and lastly I have explained about the market equilibrium. These I have covered up in the second video. Now this is the 3rd video. So if you have not watched the earlier 2 videos, I suggest you go to the playlist of my channel. Select the subject business economics. Select the videos of supply analysis. Be perfect on the previous 2 concepts, then only you can be able to understand this video. So before explaining the consumer surplus, take the screenshot of the points which I have written on the board. Then I'll explain all the points about consumer surplus. Now, the concept of consumer surplus has been introduced to indicate the consumer's gain from the goods he purchases in the market. See here, a consumer will purchase a number of commodities, goods, in order to satisfy their wants. When he purchases the goods, he is getting the satisfaction. At the same time, he is getting dissatisfaction from the money he is paying for the purchases. So something he is getting and something he is giving. So we are comparing what is the price he is paying and what is the satisfaction he is getting. If the satisfaction which he obtained is more than the price what he pays, then we call it as consumer surplus. Suppose if I get 100 units of satisfaction, whereas I am paying only 80 units of money, that means I am getting consumer surplus. So how much benefit a person will get by purchasing a commodity, a product from the market? How much benefit, excess benefit he is going to get? That is called as consumer surplus. So according to Marshall, when a consumer buys a commodity, satisfaction which he derives from it may be excess of the dissatisfaction he has experienced in parting with money for paying its price. So many a time what will happen, a person will purchase some commodities, he has to pay the price. Now Marshall has compared how much satisfaction he is getting from purchasing the commodity and how much dissatisfaction he is getting by paying the price. Suppose if the benefit, if the satisfaction is more than the price what he pays, then the excess of satisfaction over the price paid is called consumer surplus. The excess satisfaction is called consumer surplus. This is the general meaning. Now specifically definition, the concept of consumer surplus is based on the law of diminishing marginal utility. Already one video I have given on diminishing marginal utility. As a person consumes more and more of a commodity, the marginal utility will goes on decreasing from additional units. That is law of diminishing marginal. So consumer surplus is an extension of the law of diminishing marginal utility. It is the benefit the consumer gets from purchasing a commodity at a lower price, for which he would be willing to pay a higher price. So when a person will get consumer surplus, if he is willing to pay a higher price but the market price is lower. For example, I am the consumer. I am going to the market to buy a particular product, and in my mind the price of the product, I am ready, I am willing to purchase that product for 100 rupees. But when I go in the market, I find the price is 80 rupees. The market price is only 80 rupees, whereas I am willing to pay 100 rupees for the product. That means I am paying only 80 rupees. I am willing to pay, I am ready to pay even 100 rupees also. Then the excess amount is called consumer surplus. Then this may be called consumer surplus. Consumer surplus is the difference between the demand price and the market price. Demand price means the price at which the consumer is willing to pay. I am willing to pay 100 rupees, but the market price is only 80 rupees. The difference, 100 minus 80, 20 is the consumer surplus. Then the demand price is the price which a person is willing to pay. If such price exceeds the market price, the consumer gets a benefit. So consumer surplus will arise only when the market price is lower than the demand price. The demand price is the price which is willing by the consumer to pay. Market price is the prevailing price in the market. So whenever the demand price is greater than the market price, the difference is called consumer surplus. So simply consumer surplus is potential price minus actual price. The difference between potential price, the price which is willing by the consumer to pay, is called potential price, and the actual price in the market, that is actual price. This is the meaning and definition of consumer surplus. Now assumptions. This consumer surplus is based on a number of assumptions. What are the assumptions? First one, the utility obtained from the commodities can be evaluated cardinally. Utility means satisfaction. We consume a number of goods and services to satisfy our wants. The satisfaction which we get by consuming the goods is called utility. And the assumption of this consumer surplus is the utility is cardinal. Cardinal means measurable. We can measure our satisfaction in terms of numbers. For example, 1, 2, 3, like that we can evaluate our satisfaction. So utility can be evaluated cardinally. That is the assumption of consumer surplus. We can measure our satisfaction in terms of numerical value. At the time of evaluating consumer surplus, only changed price is considered and all other determinants of demand are considered as constant. Actually, the satisfaction depends on the consumption. The consumption depends on the price. So we assume that our satisfaction depends only on price, not on other factors. But normally, the satisfaction does not depend only on price. A number of other factors will also be considered in order to satisfy our wants. But here consumer surplus says the consumption depends only on the price. Next one, the utility obtained from one commodity does not depend on another commodity. That means whatever utility we are getting, there are no substitutes or complementary goods in the market. Only one commodity is there. We can purchase it or go without it. Then the marginal utility of money always remains constant. That means the satisfaction of the money power is same. The marginal utility of money will always remain constant for every commodity. That means we will not prefer any one commodity over other commodity. Marginal utility of money will remain same. The commodity must not have any substitute in the market. We assume there are no substitute, only one commodity is there. We have to purchase it or go without it. That's it. These are the assumptions on which this consumer surplus concept is based. Now, importance. What is the importance of this concept? So first of all, the government make use the concept of consumer surplus at the time of fixing taxes on commodities. So we have indirect taxes like VAT, etc., GST. So these indirect taxes will be applied on commodities. The government will consider this consumer surplus while fixing the tax rates. Secondly, the producers also use the concept for settling and changing the price of products in the market based on surplus of the consumer available on the product. So before fixing the price, the producers will see what is the consumer surplus. By considering the consumer surplus of the consumers on the product, the producers will fix the price of their product. The next one, this concept facilitates in ascertaining the degree of export and import of specific commodity depending on the surplus applicable on that commodity. The government, while making the laws on imports and exports, the government will consider what is the consumer surplus for that product. So accordingly, the law will be made for import and export by considering consumer surplus. So hence the concept of consumer surplus has both theoretical as well as practical importance. It is very important. So far I have explained about the concept of consumer surplus. What are the assumptions on which this consumer surplus can be calculated, and what is the importance of consumer surplus. Now next thing, measurement. How to measure the consumer surplus. The consumer surplus formula is total utility minus price into quantity, or simply we can write CS is equal to TU, total utility, minus P into Q, price into quantity. Alternatively, CS, consumer surplus, is equal to price prepared to pay minus actual price paid. Just now I told you the price willing by the consumer to pay. I am the consumer. I am willing to pay 100 rupees. Whereas the market price is 80 rupees. So 100 minus 80, 20 is the consumer surplus. This is the formula for calculating consumer surplus. The following table illustrates the measurement of consumer surplus. Simple one table I have given, illustrative table, how to calculate the consumer surplus. Unit of commodity X, 1, 2, 3, 4. 4 units are there. X commodity, 4 units. Marginal utility. First 1 unit 35, 2 units 30, 3 units 22, 4 units 10. And market price 10 rupees for all. Now consumer surplus is price prepared to pay minus actual price. So here 35 minus 10, 25, 30 minus 10, 20, 22 minus 10, 12, 10 minus 10, 0. If you add up, you are getting 57. So total utility is 97 and price 40, 57. So consumer surplus is equal to total utility minus price into quantity. Total utility you can see 97. Price is 40. Number of units are 4. 40. 97 minus 40, 57. 57 is the consumer surplus. It follows that a fall in the price will cause an increase in consumer surplus, and a rise in the price will result in decrease in consumer surplus. So from evaluation we can see when the price of the commodity decreases, the consumer surplus will increase. Because as the market price is decreasing, we are paying less amount. When we pay less amount for the commodity, our satisfaction will increase. So market price, when it decreases, our CS will increase, consumer surplus will increase. If the market price increases, then our consumer surplus will decrease. Right? The consumer surplus is a relative concept because utility is a relative term. Actually, utility means satisfaction. We cannot precisely measure the satisfaction. How we can compare it? We can compare and see that this commodity gives us more satisfaction and that commodity will give us less satisfaction. For example, we have two brands of cars, X and Y. We can say I'll get more satisfaction by driving X car rather than Y car. So we can say our satisfaction is a relative term. We are comparing one commodity satisfaction with another commodity satisfaction. So consumer surplus is also a relative term because utility is a relative term. Consumer surplus of the same commodity may vary from person to person. And remember one thing, The consumer surplus will not remain same. The CS will change. The satisfaction will change from one person to another person, from one commodity to another commodity, and from time to time also. Presently, I will get more satisfaction from X. It doesn't mean that always I get more satisfaction from X. A time will come, I will get more satisfaction from Y or Z. So it may change. The consumer surplus may change from time to time. Right? Now, criticism. In examination, you may be asked a question regarding what is consumer surplus, what are the assumptions, what is the importance, how to measure it, and lastly, what are the criticism against the concept of consumer surplus. There are many critics, many criticisms leveled against the concept of consumer surplus. What are the criticisms? First one, unrealistic assumptions. Just now I told you consumer surplus is based on a number of assumptions I have explained here. 5 assumptions I have explained. But all the 5 assumptions are unrealistic in practice. The assumptions are unrealistic. What are the unrealistic assumptions? Marshall's doctrine of consumer surplus has too many unrealistic assumptions. Firstly, the marginal utility of money cannot remain constant for most of the goods. That means the satisfaction which we get from money will not be same for any good. It differs from goods to goods. The marginal utility of money is not constant in real practice. But here consumer surplus assumption says the marginal utility of money is same. It is not true. First one. Secondly, most of the times consumer goods are either complementary or competitive. See here. A person for getting the satisfaction, he has so many commodities available in the market. The commodities may be competitive or may be complementary. But here consumer surplus says there should not be any complementary or competitive goods. Only one good is available to satisfy our want, whether we can have it or leave it. But in real practice, we will not come across only one good which satisfy our want. So many goods are there. That is one of the criticism leveled against us. Then thirdly, cardinal utility concept and its demand curve have no practical importance. Cardinal utility, that is the basic assumption of consumer surplus. Cardinal utility means the satisfaction is measurable, but in reality, the satisfaction cannot be measured. For example, a person is very thirsty. When he is very thirsty, when he drinks a glass of water, it gives him maximum satisfaction. Can we measure the satisfaction? Similarly, a person is starving for food. When suddenly he gets some food, he will get a lot of satisfaction. But can we measure the satisfaction? It is difficult. So here, the consumer surplus assumption says that surplus, the utility is measurable, cardinal. It is not practical. So these are the unrealistic assumptions. That is the first criticism. Secondly, hypothetical and illusory concept. Just imaginary concept. This consumer surplus is only an imaginary concept. It is illusion to measure about the satisfaction, how much satisfaction we are getting. So according to some critics, this concept is unrealistic. It is merely imaginary and illusory. Consumer surplus is prepared in our imagination. An ordinary consumer cannot realize CS in reality. See here, from morning till evening we consume so many commodities, one commodity after another commodity. Do we measure our satisfaction? No, we go on consuming it. So an ordinary person will never realize about consumer surplus. He goes on using it as long as he is getting the satisfaction. So ordinarily no person is interested in measuring the satisfaction. Thirdly, no empirical test. So there is no practical test conducted to calculate the consumer surplus. So far, only it's an imaginary concept. So this concept is purely considered as a subjective phenomena that is not capable of empirical testing. It can only be felt. This concept can only be felt, but it cannot be proved it cannot be tested empirically. So moreover, Marshall has failed to provide any empirical evidence or data to support this concept. So whatever the theory concept given by Marshall, he has not supported his theory by any practical test or practical data. Simply he has given the feelings, the imagination, the satisfaction, but no empirical test. Then impractical concept. Concept is not practical. So many critics feel that this concept is impractical. According to Professor M.I.D. Little, he says the doctrine of consumer surplus is useless theoretical toy having no practical significance. He has gone to the extreme level of criticism. He says only this is a useless toy. This consumer surplus is a useless toy having no practical significance. This is the criticism, impractical concept. Next one, last one is meaningless concept. Why meaningless concept? Because there are many commodities where a person is ready to pay any price for a given commodity. He is not bothered. Whatever price is there, he is ready to pay. Right? Example, the concept has appeared to be meaningless in case of necessaries like water. For example, a person is very thirsty. Now at this point of time, he is ready to pay any price. He has not fixed that I am willing to pay this much price only. I am ready to pay any price because I am thirsty, I need water. So at this point of time, this consumer surplus concept will fail. Similarly, the consumer derives infinite utility and can pay anything for the necessaries like water. Like water or medicine or food, these are the necessary items for our life. So a person is ready to pay any price for the necessities. So in this case, the consumer surplus will fail because he is ready to pay any price. We cannot compare how much he is willing to pay and how much is the market price available. Lastly, he would prefer purchasing it at any cost rather than going without it. Hence, consumer surplus may be infinite in case of necessaries. That's all. These are the criticisms leveled against consumer surplus. This is the end of the concept consumer surplus. Inshallah, in the next video, one more topic we will discuss on supply analysis.